tax benefits of oil and gas pair very well with these other investments. Just like real estate, operators matter, location matters. Worst case scenario is you invest, you get your tax benefits, and you get zero oil. So if you drill a hole that has no oil in it, it is called a dry hole. The IRS is a dry hole. There is zero return.
Ms. Courtney Moeller, thank you so much for joining us today. I'm so excited to have you here.
Yes, thank you so much, Johnny. I am truly honored to be here and talk about oil and gas.
Let's dive right into it here. Just share with us how you got started with oil and gas. I know you're second generation oil and gas family now. So tell us a little bit, catch us up to where kind of where you are now.
So I am from Midland, Texas. West Texas is nothing but oil and gas. My dad was a petroleum engineer. My brother drilled oil. My uncle. We have been involved in oil and gas my whole life. Oddly enough, a few years ago, I was looking to kind of get into other assets and diversify my portfolio, and really, did a deep dive into syndication. And I thought that I was going to be syndicating multifamily and things like that, but I figured out very quickly that the tax benefits of oil and gas pair very well with these other investments, these other asset classes. And there's not really very many people offering them, and you have to be very careful about what's out there. And it's very difficult to go and partner with the kind of people you want to be partnered with. So I thought, this is kind of where I shine. I'm going to bring this opportunity out. And so, I do that. And then I, invest passively in other people's, real estate deals and where they shine.
Now you started telling me about, hey, that you can actually offset W-2 income, right? So as doctors, the biggest expense that we have by far is tax. We love real estate for its tax advantages because we build income, cash flows from multifamily that is income tax free. And so these are some of the things that we find compelling. But unless we're a real estate professional or we're using some type of, STR loophole, there's very limited protection from us from paying taxes on our active income, our W-2 income. So we can use our losses if we have capital gains, we sell some of our stocks, we have a capital gains. We can use losses from real estate to offset that. But what we can't do is write off W-2 income. Now, you and I were talking about this at a lunch, and you told me that there's a way that doctors can actually save on their W-2 income. They can save money on their taxes on W-2 income. I don't want to go too much into the weeds here, but is that possible? Number one, A, and B, just high level, is it legal? Let's start with that.
Yeah, so it's funny you mentioned being a dentist. My partner is actually a cardiologist, and a lot of our investors are doctors and dentists and people that have, high, W-2 income jobs with no way to offset it. There's the short-term rental loopholes and some of these other things, but I'm sorry, as a doctor or a dentist, you do not have 750 hours and, all of these other hour requirements that you have to put into this stuff. And nobody wants that. That's not truly passive. And so a long time ago, the IRS wrote a special tax code, to induce exploration and drilling. It was a perk for people to go out and explore and drill, and it's never left. It's been there ever since. But essentially what it looks like is you have to invest in the working interest of an oil well. So you can't just go get an overriding royalty or some other things. It has to be working interest. And we'll get back into that in just a minute. But if you invest in a working interest, you get 80 to 90% of your investment against your W-2 income, passive income, capital gains, any kind of income you can imagine in year one.
Wow.
Which is amazing. You don't have to work for it. You don't have to put in any hours. You don't have to do anything. You make the investment, you get that deduction, that 80 to 90% in year one. I'm going to call it 80%. It's usually about 80%. And the great thing is that all of the income that's generated from these wells, you get what's called a depletion allowance. So you get a 15% deduction from the income every year for the life that it's paid, for the life of the wells, whether it's 10 years or 30 years or 50 years, you get that year after year. So wow. You get that 80% in year one and then a 15% deduction off the income from those wells. And the great thing, so against the W-2 income, there are some rules to that. There's a $500,000 limit to the amount of W-2 income that you can offset in 1 year. For capital gains, there is no limit. So I can offset $100 million, in capital gains, but we are capped at $500,000 for W-2 income. But I don't know of a single other investment where you can go invest and you get it against it's really any kind of income. And you can even 1031 real estate into it, which is another huge advantage. So there's a ton of incentives and things that, like I said, the IRS and tax code made it very investor friendly for people.
The difference here is where we're investing in an apartment building syndication, for example, we are taking a limited partner role, right? We're taking a passive role, and that's why we cannot offset our income from a passive investment against non-passive gains, right? Which is our jobs, our active income. But here, the nuances in this oil and gas that Courtney's talking about, if I'm correct here, is that we are taking a working interest in the oil well, right? So that means we're actively involved in the profits from
you actually have to come into the investment as a general partner. And so you've come in as a general partner, and then on January 1st of the following year, you get converted to a limited partner. So you come in as a GP, get those tax advantages, and then once the year is over, you get converted. Once you're converted to a limited partner, that does not affect the 15% depletion allowance that you continue to get as the years go on. Say you invest this year, say you invest $100,000, you will get an $80,000 deduction against your W-2 income, capital gains, whatever. Right. And then let's say in year 2, or I guess in the first year after you get that, you make $100,000, you will only be taxed on 85 because you get that 15% depletion allowance.
Got it. So, all right, so let's back that up. I mean, that was huge right there. Now, $100,000 investment in oil and gas in year 1, you can get up to $80,000 worth of losses that you can use to now offset your income tax liability on your W-2 income. So let's take an example here, Courtney, if you would please. As a dentist, he makes $180,000 and he pays $80,000 in W-2 taxes. Okay. Say that that same doctor has $100,000 in savings. He has the opportunity to invest in an oil and gas investment. He takes that $100,000 from his savings, invests in that oil and gas. Now you're saying that he would get $80,000 of losses that now he could take to offset that $80,000 that he paid in taxes?
So the way that it works, let's say in 2023, your total income was $200,000, right? Okay. The way that this works, so you're being taxed, and we'll put you in the top bracket at 37%. Okay. So you have you're taxed on 200,000, you invest $100,000, you get an $80,000 deduction. That 80,000 reduces your overall amount. So your taxable income goes from 200,000 down to 120. So now you're being taxed on 120. Right. Now capital gains, it just offset, if you've got a $200,000 capital gains problem, it reduces it $80,000. So now you're just paying capital gains on $120,000.
Got it. Okay, that makes a lot of sense. Okay, so I mean that's huge, though, right? Isn't it possible, Courtney, that if you're investing enough that you can pay zero on your W-2 income?
Absolutely.
Is there a catch to this?
These are the things that that everybody needs to understand about investing in oil and gas, because there's not a lot of people doing it. But just like real estate, operators matter, location matters, and you also need to understand what a working interest is.
What would you say? Now, is there a chance that you make zero on an investment? I mean,
yeah, so that is always one of the questions I get, what's worst case scenario? Worst case scenario is you invest, you get your tax benefits, and you get zero oil. That is worst case scenario, because you're always going to get your tax benefits in year 1, always. But worst case scenario is you get those tax benefits, but then there's never any other return and there's zero oil. And that would be unfortunate. And it has happened. But this is also where the operator and the location matter.
Hey, listen, I mean, you can lose all your money in a multifamily real estate deal. You can lose all your money in any investment that you make, right? Because anytime you invest in anything, you incur significant, especially, you incur significant risk, right? So up to including loss of capital, especially with these type of things. So that is a mindset that you have to have regardless going in. What would you say, what would be the top 3 advice that you would give to a dentist that's just starting, starting their investing journey?
Gosh, if you're just getting started, I would make sure that you find a really good tax strategist. CPAs are not all created equal, and you want to make sure that you find somebody that can help you implement a strategy. So that would be number 1, and that's for anybody, even if you're not a dentist. There's a lot of them that don't know all of the different investments. I mean, I can't tell you how many CPAs I've had to educate and give them the tax codes on this to help them. So just having a really good tax strategist in your corner is imperative. That's number 1. Number two, I really like diversification. Right now we're seeing some different assets in the real estate market struggle, and that's okay. Some of my, apartments aren't paying right now, but oil and gas is really strong right now. I think that when you have a really good, well-rounded portfolio, you might have one asset class that's not paying so well and another one that's really strong, and then they could flip-flop. Here in 5 years, real estate's going to be really strong and oil might be struggling. So I think it's really good and smart to create a really great portfolio where you've got passive income coming so that you're not dependent upon retirement and that sort of thing, so that when something is struggling, all these assets are cyclical. So I think it's smart to research them, and really you don't have to have a total grasp on it, but make sure you're working with people that are really knowledgeable and educated in the space that they're in, because that matters. And let me just tap on that, just because you see them on YouTube or on a stage, or even me on here with Johnny, does not mean that I know what I'm talking about. So double check everything that you hear, double check what I'm telling you. Yeah. So research it.
And if people want to learn more about you, I mean, what's the best way to reach out to you or learn or contact you or learn about you?
Yeah, I have my website. It's CourtneyMoeller.com, and I've got a little bit of everything on there. And I have an oil and gas report. I don't know if you want me to put it out there or not, or if people wanted to deep dive into the taxes. Do you want me to share that or no?
Yeah, I mean, we can definitely put that in the description,
So you can get this oil and gas report. It's not deal specific or anything, but just some general information, and it's oilandgasreport.net.
Awesome.
And I'm on LinkedIn. I'm not, social media is not my strong suit. I do check it here and there, but LinkedIn is a great place too.
Courtney, I don't want to hold you. Thank you so much for dropping these gems. I gained a ton from it. I got a lot of value from this. I'm sure everybody watching this, either live or on the recording, will agree with me. If you did, drop a fire emoji in the comment section, like, and share with any other like-minded individuals or with your colleagues that you think might need to hear this.